everyone, welcome to TSAM Digital. My name's Amy and today I'm joined by Dr. Greg B Davies, who's Head of Behavioural Finance at Oxford Risk. So welcome, Greg. It's great to have you on the channel.
Thank you. Thank you for having me.
Yeah, of course, you were at the Summit for Asset Management ESG last week with us, so we thought we'd just have you on the channel as a little follow-up to just discuss a little bit more in detail about your work for those who weren't at the conference. So just before we dive into some of the topics today, would you mind just telling me a little bit about yourself and about Oxford Risk?
Yeah, sure. So I guess I've specialized for the last 2 decades or more in applied behavioral finance. So bringing together ideas from decision sciences and behavioral psychology together with finance theory in order to understand how and why people make the decisions they do. And I guess most importantly, in a commercial context, to help people make better financial decisions. And that is essentially what we do at Oxford Risk. Oxford Risk is a spin-out of Oxford University. It was set up by some very senior behavioral science, decision science academics. And we are a fintech. We're a software provider, and we're doing exactly what I've been doing for the last 20 years, is combining psychology, decision science, behavioral science with quantitative finance, and particularly now increasingly more technology and data analytics, bringing all of that together to help investors understand themselves better, to match them to investments better, and to help them control and manage their emotional state throughout the ups and downs of the investment journey.
Fantastic. Thank you for that introduction. And before we get into more of those ways that behavioral finance and analytics can help with those decisions, could you just give a little bit of insight on what the current challenges are for fund managers in the current economic climate? Obviously, that'll set the scene nicely.
Well, that's a very broad topic, and I'll probably focus it in because we were talking much around ESG preferences. I think when we think about the whole field of sustainability and ESG and investing, it's constantly evolving at the moment. It's constantly changing. It's still relatively novel. People have different product shelves, and the regulation is changing. So the big challenge is really navigating that change and being flexible along with it. But not only are the investments changing and the product shelves are changing, but the investors' attitudes themselves are changing. And this is where we specialize, is understanding the attitudes and the dimensionality of how we can measure how one person is different from another in terms of what they prefer. And there, a lot of what the industry has been doing is building investment products that are slanted towards ESG from the basis of what they have already done for the last 50, 60 years. And where we need to be moving towards is more deeply understanding what investors really want from ESG. What trade-offs are they willing to make? How are investors different from each other, so that we can start to actually design funds and solutions and indices and products that start from the position of understanding the investor and then building from there.
Absolutely. So speaking of those shifting attitudes, what data, insight and preferences are you seeing? What is your information telling you about what the investors want?
Well, we are constantly doing large-scale behavioral and attitudinal surveys to really deeply understand investor attitudes. I think over the last 5 years, we've probably got data from somewhere in the region of 8,000 to 10,000 individuals. That's all research survey data, so very well-controlled samples, and that's across 4 continents. We've also, of course, got data from the profiling tools that we use for our clients. We keep those two quite separate, because when you're building them from the first, you're building these tools at the outset, you need to be controlling the samples very carefully. So the research is separate from the usage. But what we see is that there are definitely there are clear dimensions on which people can rely, people's attitudes towards doing good with their wealth can reliably be measured, and on which people differ. So what we're aiming for is, what is the minimum number of questions that explains the maximum amount of variability between people's attitudes? And so we're looking for scales where people don't agree, where we know that there are high scores and there are people who score low on those scales, because that's what allows us to differentiate how we match products to people, to differentiate the communication that we give to investors when talking to them about this. And so just to give an example there, a couple of the key scales, the one that pops out most regularly from the analysis is a very simple one: impact desire. To what degree does someone want to reflect their values in their investment portfolio? And there are people out there who definitely want to do that a lot. And there are people who just don't care that much. And we might want everyone to care more about the environment, etc. But if we're trying to match investors to investments, we need to be talking to the preferences of those people specifically. Now, it's interesting, those who don't have high impact desire, it doesn't mean they're nasty people. It doesn't mean they're not altruistic and don't want to do good for the world, because there are other scales that mitigate this. So impact apprehension. There are people out there who are perfectly nice. They want to do good in the world, but they're daunted by this new area of investing that seems very complex. It seems like I've just gotten around to thinking about how I put together a portfolio to meet my risk preferences. And now you're asking me to overlay all of this E and S and G and sustainability and responsibility. There are many investors out there who frankly are just wary of going close to this whole area because it's new and complex and feels a bit daunting to them. And some people are just much, much more comfortable and much happier doing social good in the world through philanthropy, through charity donations. So that's another scale that comes out, is your degree of preference for keeping your finances, keeping your social objectives separate from your finances, versus being willing to blend them through ESG investing or through impact investing. And I think the last scale that is important here is possibly the most controversial one, and also the most useful one, which is impact trade-off. To what degree is someone willing to think of there being a balance or a trade-off between their social or environmental objectives on the one hand and their financial outcomes on the other hand? And to a large degree, the industry for much of the last 5 years has been peddling the myth that everyone can do all the good they want to in the world for free. It won't cost you anything in returns. We'll just paint the portfolio green. We'll give it to you, and you can all then invest with a clear conscience, knowing that you have done lots of good in the world. And the reality is that stuff doesn't really do very much good in the world. If you want to genuinely meet objectives that are social and environmental, you need to go deeper than portfolios that are just excluding fossil fuel companies, etc. So long answer, but there's a lot of richness to the preferences and attitudes that we see once you measure them accurately.
Yeah, some really good points there. And I think it raises a lot of questions for asset managers when they're constructing portfolios. Like, if you've got an investor who's wary, how do you make sure there isn't too much of a trade-off? Because obviously for them, that's probably more of a risk. And then if you have someone whose priority is to do social good, how do you strike the balance between still having an optimum portfolio performance and then still making sure that they have those responsible and sustainable investment themes in there so that they feel it reflects their values? So, I mean, just to expand on that, how do you think asset managers should proceed with those two types of clients, or should they kind of have a one formula fits all approach for both of those to make sure they're getting the highest returns?
Well, I think that there are two completely separate things that we can do. Would be possible to build a single portfolio and go, here's our nice portfolio, and then there's our normal, just maximize financial returns portfolio. And you can still differentiate what you do for different end consumers, not by changing the portfolio, but by changing how you communicate with people. What narratives do I bring to the surface, etc. So for some people, I might focus more on the E of the ESG. For some people, I might focus more on the S. So it is actually possible, I think, to personalize what you give to people without even changing the portfolio. But from an asset management perspective, I think there's real value in going deeper. The data are still, we're still struggling towards consistent data to measure E-ness, S-ness, and G-ness, etc. But they're coming, they're there. And I think it is increasingly possible now to start building portfolio solutions or funds that are genuinely targeted at what we know to be significant common pockets of preferences in the investor base. So if we can identify, which we can in the data we have, we can identify different personas. Here's person persona A, B, C, D, and maybe there are 4 or 5 different ones. And each of them comes with their own package of attitudes and preferences. And we can start to say, okay, well, here's one where we focus more on the E rather than the S or the G. Here is one where we stick to the kind of the shallow exclusion. We're painting it green, where it's the do no harm portfolio, right? We're cutting out the nasty stuff, but we're not actually digging deep. And there are a portfolio over here where we're genuinely trying to push on that, on the social and environmental objectives, even if it comes at a cost of risk return trade-offs. So I think there are at least 3 levers there that you can pull to steer a portfolio in one direction or another. And once we know where the big pockets of preferences are out there of investors, it becomes actually relatively easy to start tweaking portfolio construction to match the needs of the investors, rather than just going, okay, well, here's one we've got off the shelf, let's dust it off, blow the cobwebs off it, paint it green, and put it on a different shelf.
It definitely makes sense, because I think there's a risk that asset managers sort of hear what their clients want and try to match it to an impossible combination of products, when actually, like you say, there are benefits to investing in controversial industries like fossil fuels that are undergoing transition and things that traditionally wouldn't be considered ESG, but perhaps are, bringing their own benefits and still offer rewards in other ways. So I think it's a good way to look at it as having a lot of options to choose from, rather than, trying to force something that doesn't work necessarily or can't be measured well. So thinking about how technology comes into that, how can technology help engage with investors, and how can it help navigate this complex landscape of putting together portfolios that match their needs?
Well, I think there's 3 aspects to that. One is using technology to actually understand the preferences in the first place. So at Oxford Risk, we have ESG profiling tools that are, we've looked at hundreds of questions, and we've statistically distilled these down to the things we can ask people that give us biggest bang for buck. Which is the minimum set of questions that explains the maximum amount of how people are different here. And, that means with just a few minutes of investor engagement time, we get a very rich and robust profile of what investors want. And technology is obviously the way of doing that at scale. The second piece is using the technology to actually build the matching algorithms. I might have a set of measures about your financial personality or attitudes when it comes to ESG, but unless I'm actually going the next step and going off the basis of that, how should your portfolio be different? Which funds do I select? How do I match and build them in? It's effectively the asset allocation parallel for the ESG world. So instead of mixing between asset classes to give you a risk level that's appropriate to your risk preferences, I'm mixing between different flavors and depths of ESG to give you an ESG allocation that matches your preferences. And I think unless we do that step, we're not going to solve the problem, because even if I've measured your preferences and I tell you what they are, if I don't do the next step, I'm placing all of the burden on you to filter all the funds, to build the portfolio, to know that you're doing the right thing. So as an industry, a huge part of this is not just identifying preferences, but building the tools that can match people to solutions that meet those preferences. And then I think the third one, which is very much on the asset management side of the fence, is simply the use of technology to extend traditional portfolio theory techniques, which are about maximizing or optimizing risk return trade-offs, and starting to use that technology, those frameworks, those optimization frameworks, to incorporate other aspects of people's preferences other than risk and return and liquidity and the standard stuff. So using technology actually in the portfolio construction process itself.
That sounds like a great approach. I think a lot of investors might not even realize what they want. So this profiling technique definitely sounds like it will help, because some of them might have a good idea overall of what kind of social good they're hoping to achieve in the world. But in terms of how they match that to a financial product, it's very overwhelming, especially if they don't have a financial background. So I think that sounds like a logical way to approach it, and then find out the ESG from there and then decide the risk factor. So it makes sense to me, and I'm sure that there will be so many use cases where this will sort of make things a lot easier for both sides.
Well, the big issue is if we don't make it easy for people Some of those dimensions I referred to earlier, the impact apprehension. So we know that there's a whole bunch of people who are daunted by it. The charity preferences. If we don't make it easy for people, people will go, of course I want to do some good with my wealth, but there's no tools to help me. No one's telling me, no one's helping me identify my preferences. Nobody's helping me to match those to a solution that fits, bringing in all of the sophistication of the asset management industry. So you know what? Of course I'm going to do good with my wealth, but I will go and donate some money to some charities, and I just stay well away from this whole ESG impact world. And that is the problem that we will face, and in fact are facing to some degree right now, is in no way are we yet serving the latent demand that is out there for people to be doing good with their wealth through the mechanism of their investing activities.
Yeah, absolutely. And these will be very, very relevant conversations next year, because in addition to the Summit for Asset Management and ESG series, we're also launching our wealth series, where a lot of those questions will come into play in terms of the private wealth and those client values, how to integrate those into portfolios. So I'm sure we'll have lots more interesting conversations on this topic next year. But for now, thanks so much for joining us on the channel, Greg. It's been really interesting. Great to have your insights. I hope that you continue to help people with this amazing solution.
Brilliant. Thank you so much.
Thanks. And thanks everyone for watching.